Recording. Hello, everyone. We'll give everyone a couple minutes to get loaded into the session, hopefully including our other guest, the sponsor of the show. If not, Mike and I are going to talk about spice rubs that we're making here at the farm with the team. The team can pop in.
Sourdough. We've got lots of topics to discuss.
Yeah, yeah. We rode ATVs on the trails, got very muddy, and then we took them on back roads to a cash only bar so that the team could get the full effect of the country. And then this evening we have a musician coming and we're having a barn party. So
Very nice.
the gang's all in my living room. Hi, Devin. We'll go ahead and jump in 1 minute. Devin, you are on mute.
Sorry, I was just saying hey.
No
Was
worries.
scarfing out some lunch before we got started here. So
All good.
Jody, do you need us? Are we okay hidden? Because we won't be speaking. Okay.
Yep, you're good. All right. Welcome, everyone, to the SIP, a space where conversation fuels connection, collaboration drives innovation, and industry leaders come together to tackle challenges just like catching up over coffee. The SIP is all about meaningful discussions that move us forward. Today, we are here to share insights, real world case studies, and strategies that highlight the power of working together. A big thank you for taking the time out of your day to join us. And today's show is proudly sponsored by FICO. If you are a leader trying to make sense of where credit risk assessment is headed, or anything related to credit is headed, how that shift touches everything from underwriting to the secondary market, this is a conversation you will want to lean into. And joining me today is Mike Metz, the COO of V.I.P Mortgage. Mike, welcome to the SIP.
Thank you for
He's
having me.
He's powered up, he has Wi-Fi, and his sourdough is being made in the background. And Devin, I did give Mike a warning. We are having a thunderstorm right now, so if I go away, you two take it and run with it. And joining us from FICO is Devin Morales, the head of mortgage and capital markets for FICO Scores. Devin, great to have you here.
Jody, thanks for having me. Mike, great to see you. Excited to have a fun conversation today. Hopefully your power stays up. Fingers crossed.
Yeah. So we're making spice rubs this afternoon. The team is here at the farm and Mike is making sourdough. Do you have anything cooking in the kitchen, Devin?
Uh, it's funny you asked me that because my kids are dying to learn how to make Jello. And so that is what we are doing today when they get back from camp. So it's not brewing yet, but there will be some
Yeah.
Jello in our house later.
I imagine
They
it's a
learned to make,
really messy activity.
yeah. Jello shots are learned early in your household.
No shots, just the good old-fashioned Jello.
Yeah. We also have some green beans we're going to put on from the garden, and I have some ribs in the crock pot to finish on the charcoal grill. So excited for dinner this evening. So, Devin, let's jump right in because there is a recent development worth starting with. A couple weeks ago, FICO released historical data from FICO scores 10T. Talk to us about what that means and why it is significant. And while you are at it, ground us in the basics, what it makes credit score modern, and what does FICO score 10T bring to this table specifically?
Yeah, absolutely, Jody. You're totally right. So a couple weeks ago, or a few weeks ago, the GSEs did release our 50 million data set. And we're very excited about this. You know, the release of the 10T historical data has been something that has been in the works for multiple years. And I think a lot of our clients they have had many conversations with me about getting this data out and what was taking so long and just their excitement about it. So having the data out really is that first step into 10T being accepted by the GSEs and moving forward in this Credit Modernization Act. Broad access to this historical data will allow the mortgage ecosystem to independently evaluate score performance spanning across 12 years of data, right? And I think that is really, really important. It's great for FICO to come and say, hey, our scores are great, our scores perform really well, but at the end of the day, people need to see it for themselves, and this data set allows them to do that. And we're just very proud of 10T. It's our most inclusive and predictive FICO score, and it includes both trended and rental data. And these are all things that will help more borrowers get into home. And I think the industry as a whole, that's our goal, right? Is to get more people into homes, and that's what 10T will do. And the 10T data set is the first step in that.
All right, and will you drill down on the modern piece of it? Like what makes it modern?
Yeah, yeah, absolutely. So the inclusion of trended data, like I mentioned, the 24-month look back, as well as the inclusion of rental data. Some other key attributes that are helping modernize the score as well would be the improved treatment of authorized users, right? That is a big one that I think a lot of folks don't really think about is, if I have a credit card for my son and he's getting all the benefits of, being on my credit report, well, that my son, when he goes to get a mortgage, is a much different borrower than someone like myself, right? He's just kind of reaping those benefits. So that I think is a very big one. Improved treatment of medical collections, right? We know that's been a hot topic. And so the way we're able to better segment and score these borrowers is, light years and even just more improvement on what we've already built in the past. And so those key attributes will really help modernize the credit scoring models in general.
Thanks for clarifying. And then, Mike, from where you sit, what do lenders actually care about when they're evaluating the new scores? And how does a milestone like the data release change the conversation for lenders?
So the word predictive these days, I feel like is becoming the next synergy where it gets used so much that you're almost like, I've heard that word 19 times today in the past hour. But at the same time, I feel like in this conversation, it really plays on the opposite usage of that word. You've got the predictive abilities of it. Most loan officers, most processors, most underwriters, we've been working with the classic FICO models for so long that if you say a credit score to someone in the industry that's been in it for as many gray hairs as or lack of hairs we have, that they instantly know, like, okay, what's a 685 going to look like? What's a 725? How much do I really need to scrutinize the credit profile on this one? And I think that's where the data set really, really helps with this is as we go into any new norm, what does that actually look like? And it allows people to start recalibrating, okay, 710 is the new 720, or how does that equate over? What are the things that I used to worry about of like, oh, that's a medical collection. So yeah, it's real 580, but really it's going to be more like a 610. Well, now it's going to let us start getting used to those translations. And I think some of it's going to be a learning process. And I think that'll be across the board originators, processors, and underwriters. But I think there's going to be a lot of improvements, especially on the servicing side of things. And that's where I get excited about the trended data. There was a lot of hoopla when we started talking about trended data back in yesteryear. And now it's like, cool. Now we get to see the actual ramifications of that because people are interesting. They go to buy the house and then they splurge on, well, I need to get new couches, and that's not indicative of their normal history. Um,
Yeah.
so
It's
I'm
Yeah,
always
excited.
I'd have to say that too, Mike, right? The GSEs have required trended data for years. Now it just makes sense to leverage that trended data within the score that you're actually decisioning on. So that definitely excites me. And that's one of the big things I always tell people about. We know that borrowers go get a home and then they go buy a fridge or they go buy a sofa or now they get a new car, right? And so that trended data just gives you such a better picture of what is this borrower actually doing and not just that snapshot in time.
absolutely. And Mike, I want to zoom out a little bit. What are the lenders navigating right now? What are you hearing? What are they hearing from their borrowers?
It's a fun time to buy a home. There's a lot of uncertainty from consumers buying homes right now. And uncertainty, of course, always makes every conversation more emotional. But it's also a time where, I think a lot of times we look at inflationary numbers like CPI and how it's going to affect mortgage interest rates. But that inflationary trend has a very direct impact on the consumers and the DTI for one thing, but then also like, hey, look, I'm really trying to make ends meet and I need to get this home and it's going to be better for I've got another kid coming out, those types of situations. So we're trying to help make that reality happen for those consumers, and they're a lot more stressed. And being able to have then the actual idea on, okay, are they going to be okay? Are we making a good decision with this? Everything we can get for more ammunition to help those cases, the better. And I think that's going to continue to be an uphill struggle for us here for another year or two with
Yeah.
more difficult loans, just as people continue to feel more leveraged, not necessarily in the pure mortgage sense, but just, yeah, the bills are higher, wage growth hasn't kept up. It's tough.
Yeah. Yeah. And Devin, that's the backdrop against which a $13 trillion market is being asked to adopt something new. So tell us where adoption actually stands. How is the free access program going? And what does independent validation tell us?
Yeah, no, that's absolutely right. And I think to Mike's point, the more challenging a loan is, the more tools you want in your tool belt, right? And that's where we think 10T can really step in. We started our 10T, our FICO score 10T free access program just about 3 years ago. Coincidentally when I joined FICO, and it's proven to be incredible value for lenders. We're just about 70 lenders who now have the ability to pull 10T. And we see that list continuing to grow. Quite frankly, the release of the GSE data set has only encouraged more people to want to join the program. And so we're really excited about that because not only are now you'll have ability to see historical data, but now you actually have the ability to see it on your new originations, right? So to Mike's point, and I know VIP or some that we've worked with on this is, but you want your teams to be able to say, hey, this was a 680 classic. Now it's a 690 10T, or maybe it's a 700 10T. And, having that ability is just going to make life so much easier when the time is right. So our program is continuing to move forward. Lenders are participating. They're getting the classic FICO score in their normal course of origination, and then they're able to get that 10T score to help validate performance. And Mike, you made an interesting point around servicing. I think that's a huge one, right? We know that everyone is making plays in the servicing world. And so every servicing grid I've ever looked at has always had a FICO adjuster. And so what that allows a lot of people to do is, take that classic FICO score. And if you have a 10T score, like I mentioned, it's additional tool belt that you're able to use and look at when starting to value that servicing. So we've seen lenders who have looked at it and said, hey, maybe I can adjust my servicing price by a bip or two if I see their FICO 10T is actually 20 bips higher or 20 points higher than their classic FICO. So those are some of the real ways that people in our free access program are using it. They're also looking at VA borrowers, right? So maybe a VA borrower came in and they're below 600 or below 580, and maybe they're right at the cutoff, but they're not able to actually overcome those discount points. So just like Mike was mentioning, right? Affordability is huge. And so discount points that you're charging to a borrower can be very meaningful. So if you're able to reduce that by 25 or 50 basis points, that can make the difference between getting a borrower into a home or not being able to do the loan. And so we are seeing lenders who are looking at another way to use 10T through our free access program by helping VA borrowers as well. So across all scopes, I continue to think that we're going to see more and more use cases as people try to find more and more ways to continue to manufacture loans.
Yeah. And, from the lender's perspective, Mike, when you or any of your peers are looking at the new model, what questions are coming up internally? What does readiness actually look like on the lender side?
There's a lot of questions that are asked on that side. Um, no end to those. I think the most immediate question that we get from the originators is, when is this going to be available? How much is this going to change things? How much is this going to change the scores? Am I going to be able to get new loans from it? And those are all, good, valid questions. And we can bring up rescores. I think that's another very big question that pops up for the originators. On the processing and underwriting side, I feel like the questions are more like, okay, is this going to flow over correctly into some of our other programs that are all referencing, and how is that going to work? And that's where I think a lot of the question ends up is being more on the tech ecosystem and how well they're all handling it. And of course, a lot of it is waiting on our best buds over at some of the LOS providers on how they're handling it. Um, and then from there, the secondary side, how are the investors looking at things and how is that going to play into both the servicing and the secondary side? So,
Yeah.
like I said, there's no shortage of questions.
Yeah, and that's always the question too. It's like, are the investors going to put overlays on what the agencies are requiring, and how do you know who's going to adopt what, when, and how? And it just seems like everything is appears to be a moving target, but we've had other moving targets in this industry, and I'm sure we'll figure out how to come together and overcome it together. But Mike, I'm going to stay with you because you mentioned rescoring, and this is really, I want to spend most of our time here today, but I want to hit something practical that comes up constantly, which is the rescoring. There are really two different conversations lenders have under this umbrella. Walk us through both. First, the repolling of credit during origination for various changes that come along the way.
Yeah, like you mentioned, there's kind of two ways that I think about re-pulling and rescoring of credit. And in our case with VIP, we're predominantly a purchase first organization, which I think a lot of mortgage companies share, especially if they're still surviving right now. But with that, with refinances, it's easy enough to be one and done. You pull the credit, you finish it up. If you're taking more than 120 days, I'd love to talk to you. If purchasing, though, you get your people who are like, oh, hey, I'm shopping this weekend and I need my prequal yesterday. But then you do get the responsible people where they're actually going out and getting prepared and then they're buying down the road. And that's where you start hitting up against credit report expiration limits. And one of the scariest things, it's easy on the 780s. You're not worried about the 780s. It's the person you pulled that's a 681 and or a 719. And you're like, okay, now I'm going to have to re-pull credit. How are we going to look? And like, what is my timeline looking? And I think that's one of the biggest questions that a lot of people are curious about is that change. How much is that score likely to change over that timeline?
Yeah. And Devin has a solution for us that he's going to share that I think is going to be pretty exciting. But how do we put these concerns to rest with lenders as we move forward?
Yeah, well, hopefully I have a couple of solutions. But I think one is the first one, it's, low-hanging fruit is 10T, right? I think we all already understand that if you are using a trended score, though the variability that you're going to see in that first pull versus the second pull should minimize because you're already looking at a longer period. But the other thing I have to get on my FICO soapbox really quickly is our mortgage score simulator. This is a tool that FICO developed over the last couple of years, and it's going to tremendously help originators in that rapid rescore process. So it's not something where you need to rescore them 3 times to get the score. You can now use our simulator and know exactly what your score will be based on the actions you take. And it's something that we're very proud of. It's taken us a couple of years to get it out there and get all the features, but we are finally at a point now here at FICO where our simulator tool can confidently predict based on your actions exactly what your score will be. And if you know that as a loan officer, as an underwriter, you can make much better decisions, knowing that you will not have to rescore this borrower at time of funding. Mike, I know as a secondary guy, that was one of the things I hated was getting requests on my desk and saying, oh, their FICO score went from, like you said, a 681 to a 679. Can you eat that 25 BIP adjustment? No, I don't want to eat that 25 BIP adjustment. The company doesn't want to do that. And so I think those are real case scenarios where our simulator tool will come in and will help people and borrowers get into homes.
Yeah, and what is we talked about this in the prep call that if you pull within 45 days of the original pull, that there's no negative impact to scores.
That's a great question. Yes, it's our dedupe window. So what it allows you to do is if you're shopping for a home, once you have that mortgage credit pull, you get that 45-day window to allow you to shop and it will only count as one pull. So if I were to go to VIP and then I would go to, 3 other lenders that would just count as one inquiry as opposed to four inquiries.
We
I'm
did
not
not
sure
talk
Mike
about this
wants
on the
that to
prep
get
call.
out, because that's like educating the borrower to shop more. So
It's one that we get a lot of questions about. Quite frankly, Jody, we've had questions from the investor community that's asked us about it. So it is something that, folks don't know a lot about, but that's why our team is here to, help educate, and we're happy to do so with all your members.
And I do want to dive into rapid rescore scoring, which is its own animal. And Mike, what role does it play now that entrance data is part of the picture? Can you walk us through that?
Yeah. Rescoring to me it is an animal, it's a beast. I feel like it's the unloved redheaded stepchild that everyone tries to pretend doesn't exist in our industry. And it can be used for good and it can be used for evil. And you try to
Yeah.
stop the evil. So, the rescores I define, just to make sure we're all on the same page, is I pull credit for Devin. I use whatever simulator is available to me, hopefully an accurate one, and figure out, what, I can bump his score up 5 points, help bring down his rate an eighth. Everybody's happy. And that's the good version of it. And then you've got the evil version of it of like, oh, hey, look, Devin mysteriously has no debt as he goes in for this mortgage loan, or he's reduced his payment by this, and now he qualifies with this 49.97 DTI. And obviously, you guys don't change the payment factor of it, but the scoring portion of the rescores and how that's going to change with the trended data is probably the other biggest question that I've had, because there are a number of situations where people have had bumps up in credit cards right as they go to buy for whatever reason, innocent most of the time. How is that going to end up changing with the introduction of trended data?
Devin, answer that for us. How does the trended data change this dynamic?
Yeah, no, that's a great question, Mike. And quite honestly, the trended data provides deeper insight into the borrower's overall credit history and performance, making the score more dynamic, right? I think that everyone in our industry wants to be as dynamic in every way as possible that you can be. And now trended data allows you to do that with credit. 10T looks at credit behaviors over a longer period of time. It includes details such as whether a person carried a balance from month to month, or they consolidated their debts during that time. It really can distinguish between borrowers who consistently pay balances in full and those who only make minimum payments. And so with that, you're going to see a longer period of credit behavior that's actually considered. And we truly believe that it's going to reduce the need for a rapid rescore.
And our grant finale conversation is around is around cap markets, around the secondary market, because that's where all of this is ultimately gets tested. So, Devin, your team has been out talking with broker dealers about securitization. What are you hearing, and what does the early data show?
Oh, that's a great question. So, I had the privilege, my team and I had the privilege to go to New York about a week ago, and meet with the top CMO desk as well as a couple of the top industry data providers. And I think the big thing that we've seen and we continue to hear is that FICO is the model that the industry is built on, and it is the model that the industry needs in order to overcome any of this credit modernization. And so, while we have seen some, very, very little adoption with our competitor score, what the industry continues to say is that as long as they're getting a FICO score, they will feel comfortable with how they price the score, how they price bonds, how they rate bonds, and just quite frankly, how those loans will perform. And so from that standpoint, we feel really confident that classic FICO is still still has a stronghold. But I will tell you, each one of these investors was very excited about the performance that they've seen in 10T. We went after our data was released, so we were able to ask them, what insights they have gleaned, and they have seen the lift of 10T over Classic and FICO. And so what they're really excited about is how is that going to translate to prepayment as well, right? How is that going to impact the prepayment assumptions that they're putting on these bonds? And so they're really excited about what more and more lenders who have 10T and getting them to start showing them. One of my favorite things is when I tell these guys we have 70 lenders and they're like, "Oh, do they have 10T?" And we say, "Yeah." And I could see the wheels turning in their head, like, okay, we need to go get these guys to start showing it, start delivering it. And so, what I'll say there is that the investor community wants to see 10T because they know that their models are all built on classic and they trust the FICO models. And so, from that standpoint, we're really just focused on continuing to give them as much information in that space as possible so that when 10T is broadly available, that they'll be ready to price it accurately and give lenders the best execution.
And Mike, because I'm a recovering lender and you sit where you sit today, it always comes back to the lenders on the day to day. If the agents, and I mentioned this previously, if the agencies buy it, but you can't actually sell it to your investor base, what does that mean in practice for lenders?
In practice means a whole lot of nothing. Um, the agency acceptance is obviously huge. It's the baseline before anything else can move forward outside of little rounding errors. But for the bulk majority, unless you have particularly deep pockets, and even if you do, you're still selling a lot of your loans towards the investors. And that's been a big question for us in the current climate is what are the investors going to do? The agency acceptance, but then having that comfort. And we focus a lot on the investors, but it even extends to the warehouse lines. We can't
Yeah.
forget that most of the lenders very dependent upon those warehouse lines, and the warehouse
Yeah.
lines are perhaps even more risk averse than the investors right now. And I think
Mhm.
rightfully so. So when you start talking about messing with the main predictor on whether you're going to get those loans off the warehouse line, they're very interested in asking questions. That goes into our decisions because otherwise we don't do loans.
Yeah. Have you heard of any like warehouse banks or investors ready to be the first out there to make the move?
I would
Or is
say
it
the
wait and see?
resounding response has been, we're listening.
I will
So we're
second that, Mike.
listening. We
That's
need some big player to make the move before we
Mhm.
make the move. So there's a little bit of chess match going on
Oh,
in
very
the
much so.
investor world and warehouse line. So, well, Devin, as we wrap, what should lenders be thinking about right now if they haven't already started thinking about what their credit journey is going to be?
Yeah, no, that's a great question. I think we really encourage the industry to analyze the data, right? Do your homework. Like I said, it's all public information now to see the performance differences between the scores, and see how that impacts your business, right? If you are a conventional lender versus a government lender versus a non-QM, these are all different types of borrower profiles, and so understanding how 10T is going to impact each one of those is very crucial to anything going forward. Alongside analyzing the data, I encourage people to get signed up for our program, right? Getting 10T for free allows you now to have two of the three scores that the GSEs accept and allows you to have the best insight into that credit quality of the borrower you're working with. And then really make sure that your tech stack is aligned, right? Can your LOS digest getting these systems? Can your resellers deliver you these all scores? Can your PPE handle it, right? We've done some great work with Optimal Blue, Loan Pass, some other PPEs that we're working with to make sure that they're ready. How are you looking at it from a servicing perspective, right? If you're wanting to retain servicing, using another data point is crucial, right? So we really encourage people to get signed up, start using our score. And then I got to shamelessly plug my team. One thing that I'm really proud of my team here at FICO is we all came from the industry, right? Whether it was myself working in trading. A woman by the name of Sabitha Thomas on our team came from Fannie Mae. We had someone else that ran securitized products at BMO. Let's see, we've got another gentleman who's worked at all very large institutions who ran analytics. So from our standpoint, we have a lot of folks that can help answer a lot of the questions you have, and we're here to help. And I think that's something that we're very excited about.
Yeah, you've got some big players in mortgage that we all know. You got Christy Moss, you got Eric Lappin. So it's people that we've known in the industry for a very long time and feel as though that they definitely have a pulse on the network. And you all have been great partners of TMC in providing education and at least like listening to where the pain points are for the lenders. So we appreciate it. But that's a wrap. This has been an incredible
Awesome.
conversation. We truly appreciate the insights you all shared today. A huge thank you to FICO for sponsoring this episode and to Mike and Devin for lending their expertise. And of course, a special shout out to our listeners. Your engagement helps drive the industry forward. We'll be back next week on July the 28th at 2 p.m. Eastern Time for the entire industry on LinkedIn. And if you're not yet a member and want to explore everything TMC has to offer, please feel free to reach out to me directly. So until next time, cheers.
Cheers.
Thanks,
Thank you
Jody.
guys.
Jelly.
Have a